should you consider risk parity when rebalancing your portfolio? Imagine a way to build your investment portfolio that aims to keep your risk levels steady, no matter how the markets move. That's what risk parity tries to do. It's a different approach from traditional methods that assign fixed percentages to stocks, bonds, or commodities. Instead, risk parity focuses on balancing the risk each asset contributes to the whole portfolio. So, if stocks become more volatile, the strategy reduces exposure to stocks and increases it to bonds or other lower volatility assets. This keeps the overall risk level more stable. When you rebalance your portfolio using risk parity, you do it regularly. You check how volatile each asset is and how they move together. If stocks start to swing more wildly, you sell some of your stock holdings and buy more bonds or other less risky assets. This way, your portfolio stays aligned with your risk comfort zone. It's like adjusting the sails on a boat to keep your course steady, even when the wind changes. This approach offers some clear benefits for adults managing their investments. First, it improves diversification by avoiding overconcentration in high volatility assets. This can help reduce big losses during market downturns. Second, it targets a specific level of risk, which can help you stick to your comfort zone. Third, systematic rebalancing can generate extra returns over time. When assets that have appreciated are sold and those that have declined are bought, it creates a rebalancing premium. This can add about 1 to 2.5% annually to your returns, depending on market conditions. Risk parity also adapts to changing markets. If volatility increases across the board, the strategy shifts to keep risk levels consistent. This can help you manage risk during volatile periods without needing to make big, emotional decisions. But there are some things to keep in mind. Implementing risk parity can be more complex than traditional methods. It requires ongoing risk measurement, forecasting volatility, and frequent rebalancing. Sometimes, to balance risk equally, investors use leverage on bonds or other low volatility assets. This can add extra risk if not managed carefully. Also, frequent rebalancing can lead to higher transaction costs and taxes, which eat into your returns. In the end, if you want a disciplined, risk-focused way to manage your investments, risk parity can be a good option. It's especially useful if you prefer a more stable portfolio and are comfortable with the operational side of regular risk assessment. But if you prefer simplicity and less active management, sticking with traditional fixed-weight rebalancing might suit you better.